Hello, everyone, and welcome back to Canada Accounting Insights. Today, we're going to unpack one of those core tax concepts that shows up all the time in the real life accounting practice: property income. Now, I know that when you hear property income, your mind might go straight to rental properties. But in Canadian tax, it's actually much broader than that. It includes interest, dividends, royalties, and even income from foreign sources. By the end of this video, you'll not only understand the rules and reporting requirements, but you'll also be able to distinguish property income from business income, apply the right tax treatments, and identify deductions. Think of this as your study guide plus practical toolkit. So let's dive in. All right, let's start with the definition. Property income is basically income that flows to you because you own an asset. It's a return on capital you've invested, not on your labor. For example, if you own shares and receive dividends, that's property income. If you put money in a GIC and it earns interest, that's property income. Here's the big distinction. If you're passively earning because you own an asset, it's a property income. But if you're actively involved, like managing operations, hiring staff, or putting in significant time, then it's business income. This difference matters because the tax rules and deductions can be very different. And the main types we'll cover today are interest, dividends, eligible and non-eligible, rental income, royalties, and foreign source income. So let's start with interest, since that's the most straightforward. Interest is simply the payment you receive for lending your money. It could come from a savings account, a GIC, a government bond, or even a mortgage you hold. Now, how do we report it? Corporations and partnerships must use the accrual method. That means interest is recognized as time passes, even if no cash has actually been received yet. Individuals have a slightly different rule. You need to report interest earned up to the anniversary date of your investment. Quick example. Let's say you invested in a bond on April 1st, 2024. The anniversary date is March 31st, 2025. By that date, all the interest you've earned must be included in your income, even if you haven't collected the cash. And if you have received interest payments during the year, those also need to be included, unless you already taxed them in a prior year. So in short, if the money has accrued, the CRA wants it reported. Now let's move into dividends, a topic that gets tested a lot and is crucial for understanding Canadian tax integration. Dividends are payments corporations make to shareholders, and the tax treatment depends on who's receiving them and what type of dividend it is. If a Canadian corporation receives dividends from another taxable Canadian corporation, it includes that in net income. But here's the key. It gets a Division C deduction, which means the dividend is effectively removed when calculating taxable income. So no Part 1 tax is paid. And importantly, corporations don't do the gross-up and dividend tax credit game. That's only for individuals. Here's where the gross-up and tax credit system kicks in. When an individual receives a dividend, you include the actual dividend plus a gross-up amount in your income. This gross-up is meant to reflect the corporation's pre-tax earnings. Then you claim a dividend tax credit, which offsets some of the personal tax. This is all based on the integration principle, making sure that whether income is earned personally or through a corporation, the total combined tax is roughly the same. Now, dividends come in two flavors: non-eligible dividends, usually from Canadian-controlled private corporations that earned small business income taxed at a lower rate. Since the corporation already got a tax break, your gross-up is lower, 15%, and your dividend tax credit is smaller too. Eligible dividends, usually from public companies or CCPCs, with income taxed at the general corporate rate. These get a 38% gross-up and a higher dividend tax credit. There are also other types of dividends, such as stock dividends. You get more shares instead of cash. They're taxed like cash dividends, but the dividend amount gets added to your adjusted cost base, reducing your future capital gain. Capital dividends. These are special. They come out of the capital dividend account of a CCPC and are received completely tax-free. Foreign dividends. No gross-up, no Canadian dividend tax credit. You simply include the actual amount in Canadian dollars, and it's taxed like interest income. If foreign tax was withheld, you may get a foreign tax credit. Property income also includes a few other categories. Foreign source property income, things like dividends, interest, or royalties earned abroad. These amounts must be reported in Canadian dollars, and while foreign tax may be withheld, you might claim a credit to avoid double taxation. Royalties, payments tied to the use of intellectual property like patents, copyrights, or franchises. If you created the property, that's business income. But if you inherited or bought the rights, it's property income. Mutual funds. These often distribute income directly to investors, and that could be in the form of interest, dividends, capital gains, or tax-free capital distributions. Next, let's look at one of the most practical types of property income: rental income. If you're renting out a property, whether it's a house, an apartment, or commercial space, that income is property income. You have to report it on an accrual basis, which means recognizing rental amounts when they're due, not just when they're collected. You can deduct reasonable expenses like repairs and maintenance, utilities, property taxes, insurance, advertising, and management fees. Now about capital cost allowance, CCA. Each building costing $50,000 or more goes into a separate CCA class. Most rental buildings are Class 1, which depreciates at 4% on a declining balance basis. But here's the catch: you cannot use CCA to create or increase a rental loss. The CRA doesn't want people writing off too much depreciation just to reduce other income. So, CCA can reduce taxable income from rentals, but it can't push you into a loss. Finally, let's talk about deductions. Vacant land. You can deduct interest and property taxes only up to the amount of income the land generates. Any excess gets added to the cost base of the land. Soft costs during construction, interest, property taxes, insurance. These are usually capitalized while the building is being constructed. You can only deduct them once the property is substantially complete. General rule for interest. Interest is deductible if the borrowed money is used to earn income. It doesn't matter what you used as collateral. What matters is how the funds were actually used. Example: if you borrow to buy dividend-paying stocks, the interest is deductible. If you borrow to buy a personal vacation, it's not. There are also planning opportunities. Refinancing strategy. By selling investments to pay for personal expenses, then borrowing to repurchase the investments, you can effectively convert non-deductible personal interest into deductible investment interest. Section 21 Election. This lets you capitalize interest into the cost of a depreciable property instead of deducting it. This might make sense if you'd otherwise generate losses that you can't use. And there you have it, a complete overview of Canadian property income. We've looked at interest, eligible and non-eligible dividends, rentals, royalties, foreign source income, and the major deductions you need to understand. If you found this breakdown helpful, don't forget to hit the like button and subscribe to Canada Accounting Insights for more tutorials that make complex tax rules clear and practical. And now, I'd love to hear from you. Which type of property income have you found the most confusing? Dividends, rentals, or foreign income? Drop your thoughts in the comments, and I might create a separate deep dive video on that topic. Thanks so much for watching, and I'll see you in the next video.